Michael, you go out to 4,800 on the S&P from where we are, on futures at least, at 4,270. Michael, why?
Well, I think I step back and I first look at where the earnings trajectory is going to be, not this year. We all know there's been fantastic earnings growth off 2020, but into 2022, I think the trajectory is likely to be really pretty robust. When I get to 4,800, I really am solving for not just a valuation that makes sense, but particularly the equity risk premium here. I'm not, as you know, since late March, I've been very sort of bullish on the 10-year Treasury note, and I have this slightly neurotic view that you can be bullish Treasuries and equities at the same time, and even reflation equities. There, I'll get into that in a second. But when I look at prospectively, I look at how the market's going to trend. You have an earnings stream that's balanced on one hand by 40% of the index, referring to the S&P 500, with large cap tech earnings, secular growth that has been remarkably stable, remarkably strong, remarkably consistent. And then, of course, nominal GDP between this year and next year combined, you're looking at 16%. That's really remarkable. You haven't seen that kind of sort of two-year collective nominal GDP story since the 1980s, and certainly not the few years before COVID. So you have a cyclical earnings stream that's going to be really robust. If that underperforms, you've got large cap tech that's still going to be quite robust.
Michael, tell me about the denominator of all the ratios. The pros look at ratios. They don't look at single point. Earnings to the rescue, revenues to the rescue, margins to the rescue. Can you tell me that there's going to be such denominator strength that we've got value here at your 4,800 SPX?
Well, I think the way, we're all trained to look at value on the S&P 500 or other equity indices in terms of PE multiple. I think the game really needs to shift to equity risk premium. In other words, the difference between the prospective nominal earnings yield and the 10-year Treasury rate. I think that's really kind of much more where the game is going for S&P valuation. It's a little bit more complex because you have to make a judgment about where the 10-year yield's likely to be in the future, and where that earnings trajectory is likely to be. And then you can, I think, back into reasonable valuations. Would I do that and I sensitize earnings growth into next year against a backdrop of different interest rate assumptions, I think you can make a pretty reasoned case that 4,800 at the end of the year is really quite achievable. Again, if we do have, if the economy underperforms, the trajectory of the economy underperforms, and this earnings season, if we see evidence of that, this is an earnings season and so forth, again, I think you do have large cap tech to fall back on, but there's an important point also here. We will get earnings misses related to supply chain issues. We will get, there is this persistent COVID cloud there, but I think what's really important right now in midsummer is that some of this will ultimately defer growth into 22, which is exactly what the equity market needs right now, is to see a stronger 22 story. And I think that's going to be happening.
Will the path up to 4,800 be more volatile? We have a VIX north of 20 again. Is it going to stay there?
Look, we bounced crisply off the 50-day moving average yesterday. That's been working support over the last several months. I think a lot of this volatility that we've seen is really a function of trying to understand the narrative or what the bond market is trying to say. And I think I look at the 10-year Treasury as sort of much more a reflection of likely Fed policy over the next several years than an indictment of economic growth in the next 24 months. So that process of sort of the reflation story on the equity side, decoupling from the interest rate prices you see on your screen, it is inherently volatile. I think we will get through that. I think we probably should expect to see some more volatility, but I don't think we have a lot of complacency built into the equity options market.
Well, it's been a volatile 24 hours, that's for sure.